easyJet shares rose 8% on 25 June after the board rejected Castlelake's fourth takeover proposal, valued at £6.50 per share, or £4.93 billion, yet closed at around 580 pence, roughly 10% below the very offer they called too low. That gap is not an anomaly. It is the market's direct verdict on whether this deal closes at a price shareholders say they need. The sequence of bids tells the story plainly. Castlelake first approached in early June at 403 pence, raised to 560p on 12 June, then 600p on 17 June, then 625p on 22 June, and finally 650p on 25 June. 4 proposals in 3 weeks, each rejected within 24 hours. Yet for the first time on Thursday, the board paired rejection with engagement. easyJet granted Castlelake limited access to commercial data and agreed an extension of the UK takeover panel deadline from 26 June to 5 July. That shift is the anomaly. 4 rejections with the door shut, then a partial opening. The board's language changed from opportunistic attempt to buy on the cheap to language suggesting that limited data access might produce a more attractive proposal. Goodbody analyst Dudley Shanley interpreted it unambiguously. The narrative has definitively changed. easyJet are now effectively in negotiations with Castlelake, which means the business is for sale at the right price. The question the market cannot answer today is what that right price is, and whether Castlelake, after looking at the books, will conclude it is worth paying.
The reason easyJet's board rejects each bid within hours is not stubbornness. It is a specific forward value argument built on 3 assets the current share price does not fully reflect. The first is the fleet transition. easyJet is receiving 90 Airbus Neo family aircraft through fiscal 2028, while retiring 79 older A319 planes. Newer aircraft burn less fuel and carry more passengers per sector. For a carrier operating over 1,200 routes, that transition compresses the largest cost line in the business, fuel, at precisely the moment Middle East tensions are inflating it. The board's point is that the bid is priced at the cost of the transition, not the benefit. The second asset is airport slots. easyJet owns or controls positions at capacity-constrained airports, including Gatwick and Amsterdam, that cannot be replicated by a new entrant. The company put the value of aircraft plus slots at over £5 billion at the last count, above the entire £4.93 billion Castlelake is offering for the whole business. The third, and potentially the most important for a buyer, is easyJet Holidays. The division is capital light, growing faster than the airline itself, and targeting £450 million in annual pre-tax profit by 2030. Airlines are structurally difficult to own. Vast capital requirements, labor intensity, fuel exposure, and thin margins. A Holidays business layered on top changes the risk profile of the whole enterprise. That composite, fleet savings, slot value, Holidays profit, is what management believes the medium-term target of £1 billion in pre-tax profit rests on. JP Morgan analysts wrote bluntly that the board is unlikely to seriously consider offers below 700p. Against a 650p bid and a market price of 580p, the gap between where the stock trades and where the board will engage is roughly 20%. The data room does not change that floor, but it gives Castlelake the evidence either to justify crossing it or to conclude the floor is real and walk away.
Price alone is not the only gap. Even if Castlelake reaches 700 pence per share, the bid structure introduces a regulatory risk that easyJet has called opaque, and that 2 major bank analysts have flagged as a live obstacle. European Union rules require airlines operating under EU licenses to be majority-owned and controlled by EU nationals. That rule applies to easyJet despite Brexit, because the carrier still holds EU operating licenses. On 5 July, Castlelake must either announce a firm intention to bid or walk away. Under UK takeover panel rules, an announcement to walk carries a 12-month block on a renewed approach. The data room open this week is the pivot between those 2 outcomes. If Castlelake's internal analysis confirms the board's forward value case, fleet savings, slot value, Holidays profit, the next bid is likely to be materially above 650p. JP Morgan's floor of 700p would be the minimum. Some easyJet investors have suggested the real clearing price is higher still. At that level, the structure question becomes the remaining obstacle. Does EU regulatory risk kill a deal that the price has solved?
If Castellake's review concludes that the £1 billion profit target requires assumptions the data does not support, fuel savings from NEO fleet deployment, holidays growth in a softer consumer environment, slot monetization over a multi-year horizon, the next announcement is a withdrawal. In that scenario, easyJet's share price, currently sustained almost entirely by takeover premium, faces a reversal towards its pre-bid level. Before the first Castlelake approach was reported, the stock sat at 394 pence. That is the downside the premium conceals. IAG chief executive Luis Gallego added a further complication this week, stating publicly that the EU competition framework renders any imminent bid structurally difficult, a comment from the airline most likely to be a competing strategic buyer, and a signal that a white knight alternative is not imminent. For the holder, the monitoring variable is not the next bid price in isolation. It is whether the data room produces a bid above 700p, combined with a regulatory structure both sides can defend. Either criterion alone is insufficient. A high bid with an EU ownership structure easyJet calls undeliverable is still a rejected bid. For the watcher, the entry setup materializes only if Castlelake tables a firm offer above 700p on or before 5 July, with a credible ownership structure. The trap is a withdrawal announcement that reprices the stock toward 400p within days. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.